Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How's it going today? You having a good day? Having a good day here so far. Look, we started Jazz Wealth because I used to work for bigger companies and they would only help the high net worth individuals. Everybody wants to go after the high net worth individual, and here's how it works. So imagine like a JP Morgan. We're going to use them as an example today. A JP Morgan does a lot of research in their main offices and everything. They have access to all the great data. They put together different studies based on whatever the market's doing or whatever they want to sort of explain or educate. And then they sort of submit it all to their advisors, the people that are in your local areas. That advisor calls you up, sends you an email, whatever, shares that research with you, and they look like a hero, right? And that's cool. Well, we have access to all of that, actually. So whatever they send out to their high net worth customers, Goldman Sachs, Bank of America, whatever it may be, we get to see all of that. So occasionally I like to share that with you. And a lot of times what it means is it just makes me think of a question in a way that I can help you guys. And it really frustrates me that only the high net worth individuals get access to the really good research that helps them grow their dough. And so we started Jazz Wealth to say, what if we just did that for people that had like $1,000 in their account? Like, wouldn't it make them go from 1,000 to 100,000 faster than if they had no information, no education at all? And so that's what we do really at Jazz Wealth. We help all size investors, of course, with great investment research, education, and of course we manage our own portfolios here, have no expense ratio, so you don't have to pay those extra costs like you do at other financial advisors. So here's what we got. I was going to do this big study, and let me explain what I wanted to do, and then I'll share with you who beat me to the study, and we're just going to steal their study because it saves a lot of time. So here's what we got. You know how people say the stock market was up 8% this year, right? And you go, ooh, that's nice, 8%, great. But think about it. You had to suffer for 12 months through the backs and the forths and all this exciting stuff going on. So while the stock market may have started flat for the year, right, and then went up 8%, you maybe had to suffer a pretty significant pullback. How much was this drop that you had to suffer on average each year before you got to enjoy the 8%, right? And you guys feel this. You're going through this. Last September, or October, November, December, we went through this in the stock market. It sort of tanked there at the end of the year, but going forward now, returns are great, right? So the question we were asking was, in any given year, what's the greatest pullback before we see a return, if we even do see a return? So that's what we're going to focus on today, meaning how much sweat do you have to feel and all the scared, like, oh my God, am I invested right and everything, before it goes away and you go, oh yay, I had a return. So that's what we're going to look at. And JP Morgan actually did a great job of this study, so I'm going to steal their slide. Like I said, they share this with all their high net worth customers. I'm just going to steal it, and hopefully there's not too much of an issue here because I'm going to give them credit for everything. And so you might want to watch this video while you can, because if they ask us to take it down, of course, it's JP Morgan. I'm going to take it down. So let's go over to the chart here. Let's take a look. So here is what they put together. And I don't let it scare you here in the beginning. I'll just kind of break it down for you so you know what we're looking at. The important part is the red dot. They put this together in a much better chart than I could have done. So let's look at this dot here. And I'm just going to focus on the very first one so you know what to see going forward. The red dot represents the biggest intra-year drop in the market, in the S&P 500. The gray bar up here indicates the actual return for that year. So in 1980, you had a 26% return in the stock market, and you go, whoa, I wish I was around, like I could have invested in this S&P, and put a lot of money in. 26% is great. But at some point during the year, you had to suffer a 17% drop. It doesn't mean we went negative 17%. That means the market was moving along, trucking. Maybe it was up 20%, and then it fell 17, still positive on the year, and then gained 26%. I don't know. I didn't look back to see here. It could have also started the year, fell 17%, recovered all of it, then went positive 26%. So that's what this chart indicates. Each year, what's the biggest drop that you have to suffer before the end of the year and we post the official returns? What I want you to notice is, how often does this red dot touch the gray? So in 1980, nowhere near it. 1981, kind of close there. 1982, nowhere near it. Wow, look, it was down 34%, recovered all of it and went positive. Nowhere near, a little bit closer, somewhat there, that's pretty close. Pretty close here, but I'll take it with a 34% return. You got a 34% return, you only had to suffer a 3% pullback, right? So what it tells you is the market never seems to close near lows. Why is that? Because everybody always sees it as a discount. Somebody sees the market fall and says, I'll wait. Okay, I'm going to buy that market, and they get excited, the big guys with all the money. So the bottom line is here, you don't really have to suffer very long. I mean, sometimes they're long drops, but ultimately it's well worth it to sit through the drop rather than sell into the drop. The average intra-year drop, you add up all these together and divide them up, you get 13.9 years. The stock market, the S&P 500, was positive in 29 of these 39 years that we've studied, right? And we can't count this one just yet, right? So positive basically 2/3 of the time, right? That's pretty sweet. That tells you that when the markets fall, again, don't get out when the markets fall. Find a way to participate when the markets fall. You don't have to guess the bottom. We know you don't have to guess the bottom. It's not that big of a deal. But you want to participate rather than run away. Big, scary sell-offs are going to happen at least once a year. Do you know that? And it's 2019. We have not had a big, scary sell-off yet, right? By big, scary sell-off, I mean 10% or more. Hasn't happened. What it means, if you look at this, you're saying, I did a video yesterday where we talked about what's average in the market, what's outside of the average. Right now, we are performing inside the expected range of the market, right? If we fell 10% from here, it would be expected. It'd be okay. This chart with JP Morgan is confirming that to show the markets can fall. You want to participate in that, and then you'll enjoy some of that recovery, of course, whenever it happens there. So just wanted to point that out, because a lot of times if I wait till the stock market falls to try to teach you something, you're emotional. It's too late, right? And so if you look, we do classes every week for our customers. I record them all and everything. If you look back at some of the classes, all of the scary classes, like, oh my God, the market's going to fall and all this stuff, I do it when the market's going up, because you're open to learning something when you're not scared. If I wait for the stock market to fall and then I go through every class with our customers and I say, don't worry, it's going to be fine, here's the stats. No, you're emotional, you're freaking out, it's not going to work. It's not going to stick. You're emotional, right? So I love sharing these sort of things with you. And usually I don't share them publicly, but I thought since this wasn't my research, I'd share it publicly and give JP Morgan credit for that one. So I hope you enjoyed it. If you did enjoy it, maybe you'll hit the subscribe button or the thumbs up button, or hop on over to wherever JP Morgan's at and hit the subscribe button for them, because they did a good job on this one. Good company, by the way. So, and I say that, they're a competitor, I guess, in some small way. So enjoy the rest of your day. Hey, join us later at 5 o'clock for the Closing Beat. That's a stock market update show where we cover lots of geeky stuff, but I try to really give you something that's maybe kind of advanced, but that I can teach in a basic way so you have something to take with you. I try to keep things really clean and clear here without going too far out of the woods and using big words and all that stuff, because I don't know half the words anyways. Enjoy the rest of your day, and thanks for watching. We'll talk to you soon.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.